What a great event.
What a 5 years and amazing work. We've done over 200 episodes together. I can't believe it. Tireless coverage. You're in great hands here, everybody. Enjoy.
All right, so everybody, welcome in. We've got a lot of live participants. We're also streaming live on YouTube as well as with Securitize.io. So major shout out to all of our partners and our sponsors of the TokenizeThis Summit by Security Token Market. My name is Kyle Sonlin. I have been building this business with Herwig now for 5 years. Today is actually our 5-year public anniversary of when we went live with the business. So very exciting to be bringing an exciting few-day panel. We've got all kinds of events lined up with some of the best and brightest in the financial markets, as well as the intersection of that with the tokenized world, the blockchain markets, and working with infrastructure around newer technologies to empower that capital market system. So I really wanted to take a second here to just introduce the amazing panelists that we have here today. So starting off with Cass, would you please give us an introduction of yourself?
Thanks so much, Kyle. I'm happy to be here. And good morning, everyone. My name is Cass Sanford. I'm Deputy General Counsel of OTC Markets Group. We are a market operator operating currently 3 ATSs where approximately 12,000 equity securities are traded by over 100 broker-dealers. We do approximately $2 billion in average daily trading volume on those platforms every day. And really the offering that we provide is a marketplace for securities to be traded in a regulated environment by broker-dealers, any equity security that's not otherwise listed on an exchange. So like I said, that encompasses around 12,000 securities now, but a wide, vast variety from SEC registrants to large internationals like Roche, Adidas, and Heineken that are listed outside of the US, to companies that don't report to the SEC, that are publicly traded, to digital asset trusts like the Grayscale Bitcoin Trust and others, as well as many community banks and bank holding companies. So we offer a very flexible platform for many different issuers. And earlier this year, to add to our suite of trading services, we received approval actually from FINRA to facilitate transactions amongst the broker-dealer subscribers on our market in digital asset securities. So really what that means is any equity security that clears and settles or is otherwise represented in a blockchain-based system. And so we're very excited about the future of tokenization and happy to be here with you.
Amazing, amazing, amazing. Thank you for being here. Really, really excited to dive into all of your perspectives on the industry. Could you just do one thing for me before we move on to the rest of the introductions, is just define in a very high level the difference between a broker-dealer and an ATS, just for somebody that's listening that's not quite as familiar on primary versus secondary markets?
Absolutely. So when I say broker-dealer, generally I'm speaking to the liquidity providers that are accessing our system. So we have over 100 broker-dealers and the largest liquidity providers here in the US. So think large market makers like Virtu, Citadel, GTS, all connect to our system, and they send in messages, quotations, and orders into our trading system to seek other counterparties and execute their trades. The trading systems are alternative trading systems, those we operate. So the difference there is it operates like an exchange under a different regulatory environment. But when I say broker-dealers, I'm generally referring to liquidity providers. However, as the operator of an ATS, which my fellow panelists know well, we are registered as a broker-dealer ourselves. So really think of ATS as the marketplace and the broker-dealers all connecting to access liquidity through the ATS. That's how I think of it, but interesting.
Amazing.
Different views.
Thank you for that. I think that throughout this conversation and throughout the entire event here, I do think it's important to define some of these things. We're the authors. We recently just published Blockchain Explained, which is now a best-selling book on the blockchain and financial markets. And we spend a lot of it defining these things because even within client calls or intermediaries that are inside of our ecosystem, sometimes there are people on different pages around what the acts and operations of these different pieces of the puzzle are. And I do think it's so important to dive into that. And I would encourage anybody throughout these panels and anybody watching, please keep asking these questions. Sometimes the building blocks are really important to actually getting anything done. So with that, I do want to move over to Richard. Richard, please, would you introduce yourself and Castle Placement?
For sure. I'm Richard Luftig. I'm a managing partner at Castle Placement. We're a 15-year-old company. We are a FINRA broker-dealer. We do one thing, which is we raise private capital for companies. We do so through Reg D 506C, Reg A, and Reg CF. We've had a pretty good success. We've raised multiple billions of dollars for our clients in just about every industry that I can think of. And it's been primary issuance for the most part. We did get approval for our ATS a few months ago. We have not started trading on it, but we're excited about that. That's a long, arduous process from a technology and regulatory compliance and an approval perspective. So we're excited about that. Castle Placement has a quite different approach, I think, than most other investment banks, is that we built the company as a data and technology platform and a full service investment bank. And we fully integrated those two concepts. And it works really well. The main thing I would say is that we've spent 15 years gathering very granular investment criteria data. We have 60,000 plus institutional investors on our platform. And we know what they like to invest in: industry, size, geography, equity versus debt, et cetera. And by using that information, we're able to target the right investors for each client. And we've also built a very robust set of technology tools to facilitate all the transactions. Like, we have 110 live transactions right now. We have 40 bankers and thousands of investors. So you can imagine that it's complex to keep track of all that. And our platform does that nicely. And that has helped facilitate our transactions.
That's all great. And then one little small follow-up to you before we introduce our third panelist. Could you talk a little bit about what, I guess we'll maybe save the blockchain component for later in the meeting. That may be a longer question. I was going to ask you about the tokenization component, but we certainly may dive into that a little bit longer. But what are you excited about with respect to the blockchain technology with your business?
Well, blockchain, equity crowdfunding, traditional capital raising, and NFTs, and several other components are all smashing together. And when you put regulatory compliance and technology in the mix, it's an extraordinarily exciting opportunity for more new issuance, and secondary trading, which is really not a gigantic thing right now, but we think is going to be a gigantic thing in every asset class: real estate, art, regular corporations, really every asset class. So could not be more fascinated by how it is all coming together.
Exciting. Yeah, that's a great segue into our third panelist here, Jamie Finn. who is co-founder of Securitize. They've been dominating this space from the tokenization component for many years now. Jamie, could you introduce yourself to the crowd and talk a little bit about where you guys are focused right now?
Sure. Jamie Finn, president and co-founder of Securitize. We work across a variety of different categories here. So we operate a broker-dealer for both retail, accredited, and institutional investors. We have a primary marketplace where you can go in and buy different products. We also have a secondary platform where you can trade, you can buy and sell through a limit order book on our platform. Again, it's available for people to log in and kind of access directly. It's a little different than Cass's world where they're dealing more with broker dealers. We're dealing more with investors directly. And then we're also a transfer agent through Securitize LLC. And actually, we have a bunch of customers in common with the OTC markets folks because we act as a transfer agent for a variety of those firms. So I think one of the key concepts here is that there is a real need to kind of work together across this ecosystem and kind of really connect the dots. We were, on this topic, I think we're going to dig into liquidity, but, I think liquidity begets liquidity. So we need more people connected to get there. And these, different players are all actually very complementary. It's an important thing to note in kind of what we do. And we work with others already. Our TA has multiple products that are listed with us, with T0, with INX, and with OTC markets. So you can see there's a real kind of interconnection there that I think is crucial to talk about.
Great. That's exciting. And you mentioned liquidity, and that's really what the focus of this panel is. I've been in the security token industry now for, as we said, it's the 5-year birthday of STM. And as we've been building this, it's been more than that. And this is the holy grail of tokenized securities. This is kind of what has always been pitched as this really exciting opportunity of leveraging a digital asset to represent what is traditionally a very paper share that is very difficult to move from one place to another. If we can use technology to enable that, there's a huge opportunity here. The problem, as we've explored and as we've seen STM, we track a lot of data on what's going on in the secondary markets, and it's very thin with respect to the liquidity. And there are maybe a lot of reasons for that. We can dive into potentially what some of those things mean. But first, I want to start with Richard and talk about, with the placements that you've done so far on the primary fundraising side, when you have an issuer, when you have a client come and they're looking to fundraise for whether it's debt or equity, whichever structure they do, what are the investors getting with respect to that? And what's their timeline look like to actually potentially receive a return or a payout for one of these more traditional instruments?
Sure. Two totally different answers. One for Reg D 506C and the second for equity crowdfunding through Reg A and Reg CF. Totally different animals, different process, different technology, different investor base. In the institutional space, it's really a 3 to 5 month process. And the investors are doing an extraordinarily deep dive into the opportunity. So there's a virtual data room, and they're looking at financials, legal, strategy, competitors, cash flows, projected cash flows, and asking thousands of questions and negotiating complex legal documents that are specific to that structure for that transaction. In the equity crowdfunding space, completely different. There's one place where the information is. It's on a landing page at castleplacement.com, and the investors just bop on there, whether it's from an ad or they just come to the Castle Placement website, or they hear about it from a friend, or they read about it, and they read about the opportunity on that landing page. It's all contained. There's an offering circular attached to the landing page through a link, and they can read the offering circular. Some do, some don't. But when they want to invest, they just click on our Invest Now button and put in their information and the amount, and the fields that are required for us to do the requisite background checks, AML, KYC, suitability, and then they just pick the way they want to pay for the investment: credit card, ACH, Apple, Google, self-directed IRA, mail in a check, wire the money, whatever they want to choose, and they click and they're done. So it's a much less rigorous analysis. It's much faster, obviously. It's lightning fast. And it's an important distinction because I think secondary liquidity is going to fall much more in the camp that's closer to equity crowdfunding than it is to an institutional due diligence and closing process.
Jamie, would you agree with that perspective, that the secondary markets kind of are starting to look a lot more like the equity crowdfunding process? And has that been your experience with Securitize?
I mean, in terms of trading, I don't see the link directly, because what we see is people will come in, maybe in the speed, I suppose, in terms of transaction, because people will come in, they'll have a look at the asset, and then they'll decide if they want to buy or sell based on kind of the information that's available, and not doing a deep dive into the firm, although all the information is available for them to do a deeper dive. I think most people are kind of learning about the firms and then making decisions there. So I think there's a lot of different ways to trade these things. And I think that's a really important nuanced concept, is like, do you operate a continuous market? How do transactions get processed? How long does it take to settle a trade? Who can buy? Who can sell? How are those things put together? How does the money get transferred? What does settlement look like? I think there's a ton of questions that pop up because not all of these kind of environments are the same. And so it's important to understand kind of the features of each one and what's available. Because just having an ATS isn't, it's hard to touch and see. Like, you need to be able to use it as well. And so that's the piece that, at least for me, I've struggled with understanding over time, is like, how do I actually access and use this product?
Right. That makes a lot of sense. Do you think that may have an impact on the user experience of an investor trying to participate in the secondary markets?
Well, I mean, for an individual investor, there's really, a few marketplaces, and they kind of all work the same way, to be honest. Some of them are more crypto. When we talk about tokenized securities specifically, some of them are more kind of crypto experiences, like INX is more of a crypto experience, where like T0 or Securitize Markets is much more of a like Coinbase type of experience, where you have a centralized kind of market where people come in and trade. You're not using a crypto wallet per se to process a transaction. So they're just very different experiences that are out there.
Right. Makes sense. And so, Cass, this is kind of where I want to ping it over to you. When your firm may see a client that's looking to work with OTC markets for that secondary listing and liquidity opportunity, what does that path traditionally look like for them? And is this a viable, feasible opportunity? Are there a lot of kind of headaches in making that process happen due to, some of these infrastructural components? And just, could you walk us through that a little bit?
Sure. I think it helps to kind of, if we're talking about just a traditional company, maybe joining our markets, and perhaps it's someone who's raised capital privately through a 506C deal that Richard spoke about. And that's what we see primarily, right? That's where a lot of the dollar volume is, at least in the private markets, is through private capital raises. So I think there's a couple of tracks to look at. If you look at that kind of traditional company they've raised shares privately from investors. And really what we see is, okay, maybe there's not an IPO onto an exchange on the horizon, but their investors are starting to call and ask about liquidity events. What's the plan? Are you going to go public? How can I get liquidity? And so one option is to join the OTC markets, which is a more streamlined, less burdensome and costly method of being public. And it's really an interesting pathway for those types of companies that are not subject to registration requirements with the SEC. So they've not met that threshold to become a SEC registrant, but they still want to develop a private market. So we have a pretty streamlined process to go public. I think the biggest hurdles from the corporate perspective, from looking at it from the issuer's angle, is really you have to take on ongoing disclosure requirements. Again, they don't necessarily have to be through reporting to the SEC, but you need to publish annual and quarterly reports, because that is the only way to develop a true public market here under the regulations. So if you're transacting privately, you're not necessarily having to go through those disclosure requirements. But if you really want to access the public markets, you're going to have to do that. And then there's a few other back-end things, which I think lead into the conversation about tokenization a bit more, which is, generally speaking, if you want to kind of be able to access that institutional liquidity in the public markets, so have access to those market makers that are really going to be able to transact in those shares, you're going to need to get DTC eligibility. And so I'm jumping right into the kind of back end of the public market.
Let's do it.
It's important because what we're thinking about as we're kind of contemplating the future of public markets, and particularly in the more alternative space that we play in, what does an alternative to DTC look like? And just for those out there, it's the Depository Trust Corporation, and that's really how all institutional firms are able to transact, in milliseconds in the public markets in equity securities in the U.S. So how they're able to clear and settle, and so
one company kind of at the top connecting everything together, right, between all the institutions.
That's right. So I think that's kind of the traditional path. And like I said, we have a lot of different avenues to going public. But I would say if within this context of raising capital privately and then going public, that would be the most traditional path. Of course, you can do a share registration with the SEC. There's many options for non-US companies, but that's really what we're looking at now. And I think it's really about how do we make other rails for securities to perhaps trade, settle, clear. Jamie mentioned transfer agent services that Securitize provides. How do we build, transfer agents 2.0, clearing firms 2.0, and so that we can move away perhaps from this centralized system that we're working on now and explore other more efficient options.
Yeah. So I was exactly what I was going to ask. Like, from your perspective, do you see this almost as an efficiency within a time to settle perspective, and then maybe just a cost of capital perspective for really where the benefits of tokenization are applied in that context?
Yeah. And I think it's also just about building other models that maybe even serve a lower volume or more thinly traded market, right? Like a lot of the securities that trade on our system, and I think a lot of the tokens that we've been speaking about, they're not going to trade in the volumes of Apple and Facebook, right? And so the more centralized systems like DTC, they're really built around those high volume exchange listed stocks. So we're very large proponents of supporting smaller companies that they're maybe more thinly traded, but brokers still want to trade them. There's still investors to serve. And so other options is really, I think, what we're after as well for different types of market models.
Fascinating. Richard, you also mentioned tokenization potentially being an opportunity from the distribution perspective, perhaps, getting exposure to a wider base of investors, perhaps bringing down the investment minimums required to process a transaction. We've certainly seen Securitize leveraging that with some of the funds that they've worked with on an institutional side. Do you think the real exciting opportunity within tokenization on top of some of the things that Cass mentioned, or do you see it a different way?
Oh, no, I see it exactly the same way. And I think Jamie made a great point, and he even used that controversial word, centralization. I give him kudos for having the courage to say that word out loud. So we've found that the most important thing by far, like 95% of the equation, is the marketing. It's the bringing the investor and the issuer together. And unfortunately, most people in this industry, I don't think, focus on that component. I think most people focus on the technology more than the marketing. And I think it's a big mistake. You can't just, throw up a marketplace and hope that people will come. You can't do a capital raise and hope that people will come. It maybe someday, and there are some platforms that have a built-in audience of participants, and it will be easier for them to access investors. But for the most part, you have to build a system to bring investors to the opportunity. And that has been our focus for 15 years. And it's really hard. 10 years ago, when we built our app, it's called the CP Go app. And we were so proud and excited. And we launched and no one came. Like, how would they? How could they? How would they know about it? Like, we didn't understand how much hard work was required to communicate to the world, I guess, that there's this really good tool. There's this, whether it's a marketplace or whatever, you got to get the people to the party. And that's really hard. I don't know if anyone read the book, The Cold Start Problem, but that's what it's all about. It's cold start. You've got investors here, you've got issuers here. In the secondary market, you have buyers, you have sellers. You got to get them there. eBay figured it out. We all together, and I think Jamie mentioned collaboration, hugely important. We all together have to figure out how to connect the dots.
Yeah, what you're saying really resonates with me. We actually conducted a crowd fund using Securitize's platform, and it was a all hands on deck effort over a very consistent period of time to advocate for the offering. And certainly there are restrictions around how you can communicate and what you can say and all these different pieces, but it took quite some effort to bring that product to market and to see any level of success. And we're very proud of that. But I definitely, what you're saying, it certainly hits close to home with us.
And you learned a lot about escrow agents and transfer agents.
That we did. But we were one of the first, or perhaps the first Web3 offering. We actually issued a token behind it on Avalanche, which we're pretty proud of, that does represent the underlying security. So, I think there is a best of both worlds opportunity there. And so I want to kick it over to Jamie, who is our real thought leader in the tokenization side of this equation. And so looking at how crypto has built extremely deep liquidity in these assets that are certainly much less attractive from just an institutional perspective when you're looking at what they're actually valued at. Maybe perhaps the only reason they're attractive is because of the liquidity that they've been able to bootstrap. What can we borrow from that, or what do you think is needed in order to create more liquid markets in some of these private securities specifically? Do you believe that they're just inherently less liquid because of the fact that they're earlier stage, there's maybe less information coming out, holders have a longer time horizon because they're expecting it to appreciate over time? Or do you think that there are opportunities like empowering more LPs, building market making opportunities, having underwriters? Where do you see the opportunity to build more liquidity in some of these private markets?
Yeah, I think as a firm, we've spent a lot of time working with funds, and that space I think is a really interesting category when it comes to secondary market transactions, because there's a ton of secondary transactions that happen in the fund space. In fact, there are funds that are set up just to buy and sell secondaries. They're called secondaries funds, right? And so there is inherent liquidity in the market. It's just not at the retail kind of level. So I think what you need really is a high quality product that's well understood by the investor community, and when that product's out there and they know the firms that are in it, they know what's involved in it, they're able to trade it. Because if you were to go in and let's say you take an example, your friend's venture fund who's, in the second year of operation, probably not going to have a ton of liquidity. People don't know the firm's in it. They don't know what's in there versus, I don't know, a KKR fund that's trading on a secondary market where actually there's a ton of institutional investors that know everything about every company in that KKR portfolio and can decide if it's fairly valued or not. Because at the end of the day, there's normally a kind of a liquidity discount that kind of comes up. That is another one of these painful realities is how do you transact, and do you expect, why would I pay you a premium on a certain product versus, taking a discount on it? And I think that one of the key pieces is as the market gets made, you're not going to see things necessarily trade, particularly in the fund space, at NAV. You'll see them trade at a discount, but you'll also see it traded amongst, more intelligent kind of investors who are more savvy, or sophisticated, intelligence not right, but more sophisticated investors who understand the intrinsic value. And the other, piece, and Richard mentioned this, is like, how do you bootstrap liquidity, right? And I think in the crypto world, what they did a great job of is inventing magical internet money, like my co-founder Carlos says all the time, where it's like you come and you buy or you trade, or you put money into a market making, app or DApp, if you will, and then suddenly you get like some random governance token that's worth money that you can sell somewhere else. That's how you bootstrap liquidity, right? And they did a great job of that. And building a two-sided marketplace is extremely difficult. It takes a ton of investment and time and trust. And I think that, at least on our ATS, we see people transacting on a daily basis. The volumes aren't huge, and you wouldn't expect them to be, right? You'd expect them to be kind of smaller transactions. But as you have more products, somebody like OTC Markets, who has, literally tens of thousands of listings, they're going to see a ton more liquidity than, what we're going to see with 8 or 9 things listed. And so it's really about connecting these networks to be able to kind of drive a lot more liquidity into the space, and making it a bit more homogeneous so that it's not like a bespoke special relationship to get something to work. No, it should just work, right? The interfaces are there. Stuff should just work. If it's on a blockchain or it's in a traditional format, who really cares? What people care about is the asset, what they're buying or selling, and it should just be easy for them to do that.
Jamie, you just absolutely nailed it. In 2003, all we talked about at our office was Netflix. And people would come in and we're talking about Netflix, and they had no idea, they thought we were a little crazy, but it's no different. Capital raising is no different. You need to have a bunch of subscribers, and you need to have really great content. And the more great content you have, the more subscribers you'll have. And content is issuers or secondary securities for sale, and subscribers are investors or buyers. And just like Netflix had to have some breakout shows where people would come into the office or at a party and say, oh, did you see? Did you see? Did you see? You've got to see. That's what is required in our space. It's got to be, hey, I just invested in this really amazing company. I just bought KKR shares in secondary. It's awesome. And, you got to get that buzz, and then the investors will come to the platform. And if the investors will come to the platform, then the issuers/sellers will come to the platform. And that's the whole game. And quite frankly, we're not doing a great job, I don't think, as an industry. I think a lot of it is because of the regulatory challenges. I think, people spent 5 years building secondary platforms, and then they ran into blue sky laws, and they had to kind of hit the brakes real hard and say, what are we doing here? And, in secondary sale of corporate securities, people figured out that there are rights of first refusal that the companies hold and other legal impediments to just freely trading stuff. And it got a little ahead of itself, just like the ICO market got way ahead of itself without thinking about the regulatory compliance and legal ramifications. So it's there's a roadmap. It's definitely going to happen. No question. It's going to happen, but it's challenging.
Yeah, I think you make some great points. Certainly, this has been a common talking point in the private security, specifically tokenization, where many of the deals coming to market are risk capital deals, right? They're entrepreneurs or they're companies that are kind of looking at all of their opportunities to raise capital, presumably because some of the traditional methodology hasn't been as prosperous for them. And so we've heard this quite a few times. I think it really is interesting to hear you saying it as someone that's spent a lot of time on the traditional side of the industry. That quality of deal and quality of messaging are so important. I do though think that there is an infrastructural component here, especially on the secondary side, because, and I want to kick this over to Cass and hear her perspective, because I know that there are, and I'm certainly no expert, and none of us on this panel are necessarily providing any legal or financial advice. But as far as I understand, from ATSs, as a secondary marketplace, there is a differentiation between order books and order matching. And then I believe that OTC, you guys have now an intra-broker quotational system. So could you talk us through a little bit about what those secondary mechanics look like? Because I think that can have a pretty significant impact on price discovery and how quickly an asset can change hands, which may also play a part in secondary market activity.
Sure. It's not often that I get asked to talk about our inter-dealer quotation system, but
I'm a finance nerd, and so is everybody else listening. So
that is the technical regulatory term. It's called the inter-dealer quotation system, and that's our core trading system. We've had that for years. So that is really that term in statutes dates back to the 70s, and really the idea is that you've got a network of liquidity providers, brokers. They're all connecting to publish quotations. And those are all terms of art. So I'll try and break it down for you. Which is, the key part is publishing quotations. So think about it as a very high-tech, high-speed message board. And that's really what's happening. And so you have broker A putting out a bid in a security and posting that up and saying, here's my interest. And then broker B on the other side putting up their ask. And those two parties are meeting. They may even be messaging each other to find a price point where they can trade. And so it's not that is a fine distinction between an exchange model or a traditional matching engine ATS, where the two orders just come in blind and match in the middle. It is about posting quotations, and that type of model, it tends to work better for more thinly traded securities and for alternatives. And so that's actually, that's the ATS that we received approval to trade digital asset securities on. And the kind of the great part about that system and the way that it works is that it allows for collaboration with other market participants. So just to get back to Jamie's original point, we are wanting to work with and connect to any different type of market, whether you're a market maker and you're providing liquidity as a service, you're standing out there to quote and get that liquidity going in the various asset, or whether you're another marketplace ATS and you're sending your exhaust to us because you perhaps had a quote that didn't match on your system and you want to reach a broader audience. So connecting that system that we use, that's really just, we're not receiving transaction fees on those matches on that system. What it is about obtaining the network effect. And so, like I said earlier, we have over 100 broker dealers that also have their own ATSs, some of them that are connecting to that system just to source greater liquidity. And once you get that price transparency out there, I think that's what accessing the network of liquidity providers and then getting price transparency out, so investors can actually see, okay, this is the current bid ask, and here's the spread for this asset. That's really when you start to develop that network. And so what we're just really excited as well to collaborate with folks that are more acting in the private markets and looking to transition some of those assets to the public markets, as well as those that have alternative models, right? I think it's like we need to start, it's a very flexible system that we have because it operates just as that quotation medium, right? It's not very prescriptive. You can post a bid and an ask, and then you can clear and settle that with your counterparty on whatever system you choose. Generally it's DTC, but like I mentioned earlier, but it could also be a blockchain based system, and that very like the interdealer quotation system model accommodates various, market models.
Yeah, no, I think that was a great breakdown, and I think you're spot on. I believe that most, certainly retail investors, are much more focused on market orders as opposed to limit orders with respect to the price. They're more interested in, I want to buy these shares to I want to get involved with this company, but I want my order to be filled. I don't really want to have to haggle over specific prices or filling different orders at different quantities, as sometimes you might see with an order book style of model. The other question that my mind went to immediately when I'm hearing about this kind of we find a price in the middle style thing is I'm thinking bid-ask spread, which makes me think, well, is there an opportunity potentially to layer in third-party market makers that could inject some additional liquidity into this system? Does that present an opportunity that you see in the relative term, or is that maybe a longer term wishful thinking kind of strategy?
No, I think that's one of the problems we're trying to tackle now. A lot of the newer blockchain-based models out there are focused on serving the retail investors, which is fantastic. But we're trying to introduce the different kind of framework with which market makers operate, right? So to get those models to speak to each other is going to take a little bit of, I think, operational just understanding, because
Sure.
The market makers have a very different, they don't want to know who the end consumer is, right? And so there's understanding how retail brokers work and the markets that are serving directly the retail customers, and how to connect those to the real liquidity providers, the market makers, is going to be huge, I think.
Jamie, what has tokenization allowed your business to capitalize on with respect to this process? You guys are a broker on the primary side. You certainly have the transfer agent to manage the underlying cap table. You've got the secondary market ATS. You have the tokenization engine to create these tokens and host them in a wallet. Where do you see the opportunities with tokenization? Is it leveraging stable coins for payment, which maybe kind of streamlines the payment rails? Is it the managing of the cap table by having, more of a smart contract style system? Or what do you see tokenization providing to this process now that you have a lot of the end-to-end process all in-house?
Yeah, I mean, I think what we see is it's really important to understand kind of the key thing that the blockchain brings to private securities, which you don't have in the traditional world. And that's, you have provenance, right? So you can absolutely prove who owns what and if the asset's encumbered or not, right? So at any point in time, the token serves as proof that whoever it is who's transacting owns it. And then that means that they can do something with it. Now, what you can do with it, I think we've only seen kind of the early use cases of. And just like we've seen in lots of other industries, be it, music, which has evolved tremendously, or communications, which has evolved, tremendously once it became digitized. I'm sure we're going to see the same thing here. So like the most basic thing to do with the token is be able to transfer it from person to person. Great. Next step up is trading, buying and selling from, people who don't know each other, or groups that don't know each other. The next step there is borrowing. Right? Borrowing and lending. That's a really interesting space. How do you do borrowing and lending? Well, I don't know yet legally, but I can tell you that the first step to be able to borrow something or lend something to somebody is to prove that you own it. And once we can prove that you own it, then you can do something with it. And then you don't want the same thing happening two times, right? So if we do a deal where I take a loan from you for $100,000 against my KKR position, then you don't want me going on an ATS and selling that position to somebody else without you knowing, right? And so blockchain technology prevents that from happening programmatically, which is great. In the real world, you could do weird stuff like that because it's paper-based. So you could sign a piece of paper with one guy, make a trade with another person, and in the end, someone's got to clean it up in a lawsuit. So I think, from that point of view, we're at the very, very early stages of this. There's good applications that have come up. I think they're the most obvious ones. I don't think all of the use cases or kind of apps, if you will, have kind of come to market yet. And it's interesting to see the different worlds, right? So the US has a very, its blockchain regulation doesn't really allow for certain things that would be really cool. Like the ability to transact on an ATS directly using Web3 technologies, you can't really do here. You have weird intermediaries to make it happen, or you do a centralized approach. In Europe, we operate we've launched it. Everything's up and going, where we have a broker dealer in Europe as well, which offers primary and secondary. And the European regulator has demanded, this is totally weird, that the ability to transact, with an atomic swap is the primary way that it should work. And if you just take a second to think about that, it makes a lot of sense, because when you're using a Web3 app, you basically are transacting dollars for securities instantly, and they move from one person to the other instantly. And there's no clearing or anybody in the middle. There's no transfer agent that has to manage that. It's a direct transaction between the two. And it's a lot more efficient, and that really eliminates cost. I think that one of the issues we have, and that I've observed, at least in the space, is when people move into the tokenization market, they look to replicate all of the infrastructure they have in the traditional market and then add a token. That is a huge mistake, because you're just adding more cost on top of it. And for this tech to succeed, it really needs to be cheaper, better, and faster. And the only way to do that is to get rid of intermediaries that don't provide value. But the regulation here does give you some challenges with respect to that. I think most of it can be overcome. At least we've seen it, and we've been executing some of that stuff for years. But when you get, a really traditional asset manager wants to do something where they have a token, they kind of want to do it all the same way. And so re-engineering that process and that way of thinking, I think, is going to be one of the biggest challenges overall.
That's a really, really great perspective. I think that anybody listening is really getting quite valuable insight from all three of you. We have about 13 minutes left here in the panel. I just want to take a second to let everybody know that's listening here. We have a full schedule of events. This is not the only panel that we're going to be talking about today. We're covering real estate. We're covering compliance and back office. We're covering the technology and everything inside of this amazing industry here at TokenizeThis Summit. So I wanted to thank our sponsors, Oasis Pro Markets, Red Swan, and a whole host of others. You can find all the information throughout the event, and we're certainly going to give plenty of coverage to all the different keynote speakers throughout the day. So I want to kick it over and back to Richard. So talking about the fundraising environment today in 2023, and certainly less than liquid environments than we've seen in the early 20s, and with some of the more liquid environments, and certainly from a fundraising perspective, what are your outlook for 2024 on what this environment might look like? Are you bracing for trying to find new and innovative strategies to capture the same amount of capital? Are you feeling like, this is maybe just, burning out some of the non-serious players, but your capital stack and base will be fine? What's your perspective for 2024?
Sure. So, we were born coming out of 2008 and the collapse of the entire system. And we've kind of always thrived in the esoteric or contrarian strategies. So this is all fine for us. We actually rather, we don't want to see anyone suffer from losses or pain, but our investors like that. And just a perfect example. So I don't know if anyone's following the mortgage banking space, but it is the worst it's ever been by far, including 2008. Mortgage bank platforms are just suffering immensely. No volume and very high costs, and it's just a real problem market. So one of our clients is very contrarian. They're a large mortgage bank, and they hired us to raise $100 million to go out and buy a bunch of mortgage bank platforms that are challenged right now. And that is attracting incredible investor interest. Whereas other sectors, to your point, are not. It's just so. I would expect that 2024 will be more of the same. Certain types of strategies, certain markets, certain industries will be in favor, and investors will be quite active. Certain sectors, you don't want to go near it. That's my thought.
Does anyone else on our panel have any thoughts around that? Not particularly. So then let's go into the other question I had. And Jamie, I wanted to start here with you, and then maybe we can kick it over to Cass and get her thoughts. Here at Security Token Market, we're tracking all kinds of tokenized assets. And what has really caught our attention over the last 18 months has been the meteoric rise of institutional debt financing leveraging tokenization. We're seeing banks all around the world exploring test cases with institutional debt. UBS has done half a dozen, for example, and many other banks are underwriting and providing services for this. We're seeing Swift network trialing payments infrastructure using public blockchains, private blockchains, enterprise chains. We certainly are seeing, to your point, the MiFID frameworks coming out of the EU, the regulatory systems, the sandboxes in the Monetary Authority of Singapore, and everything going on worldwide. What are your thoughts on this kind of banking application of the tokenization technology, and how does that impact the rest of the market?
It's a pretty big question. Look, I think that the firms are looking for more efficient ways to transact and to be able to deal with these assets. And I think that right now, a lot of the things you've mentioned were really kind of in the kind of science projects phase still. I don't think we've seen, anybody really do something at scale seriously and just commit to it. I do believe we're going to see that in the very near term, because I think we've seen a lot of sort of subpar products come out that are attracting significant interest. So if you were to look at, what's going on with money market funds outside of the US, right? Because the interest rates here are so high, there's a bunch of real world asset tokens, which are not the real thing, but they position themselves as the real thing. That seems to be working. People seem to be really locked into that. I'm confident that, we're going to see the real thing kind of come to market in a real native crypto way, not something where it's sort of encumbered and locked into a specific app or use case, because the power of all of this stuff really is about it being open and accessible. If you're going to do it in your own app with your own stuff, don't bother to make a token. It's just extra cost. Just use a database. So, I think that that's really the core piece, is this kind of global access to real tokenized product. Seeing stuff on, private permission blockchains, not really that excited about. We've never been that excited about it because you can't do anything with it. And so the whole developer community gets thrown out the window. So, I think that doing things properly, bringing it and making it the real thing, not somebody else's version of it. Like Coke is the real thing. Like, you got to have the real thing with the real brands, with the real firms getting into the space. And then you're going to see real innovation and adoption at scale. So in my opinion, those are the types of things that are missing in this space right now. But it feels like, we're going to see this evolve very quickly. I mean, I think if you look at the evolution of the ETF market and kind of what happened there, is not going to be, I think you're going to have kind of a very similar trajectory in this world on the blockchain side to what happened to ETFs. And it really just went from nothing to, scaled up. And I don't think people anticipated it. And now they're kind of tapping out because of the cost associated with it. So you want to lower costs, reduce friction. Tokenization is a really good example of a way to do that.
Yeah, I would just supplement what Jamie just said, because he's exactly right. 5 years ago, we had a potential client, very, very good friend of ours. And he started a new company in the pharmaceutical space, and it's a great company. And he wanted to raise $35 million, and he wanted to hire Castle Placement to do it. And he's a very innovative guy, and he wanted to sell tokens instead of selling securities. Or instead of selling, I shouldn't say that. Instead of
traditional format.
Instead of selling paper.
Traditional format. Thank you. Exactly. So we said no. And the reason is, at that time, we didn't have investors that had wallets. They didn't, we would have to present the investment opportunity to them and then teach them how to open a wallet. And that putt is way too long. So we just said no. And it turns out that someone else said that they would do it, and he tried to do it. And unfortunately, we were right. And, now fast forward 5 years, I still think the type of investors that play in this space, for the most part, don't have wallets. So that's just one example of I think, what Jamie was articulating. A lot of components have to come together for this to really take off.
Awesome. Well, this has been a great panel. We've got just a couple minutes left, so I want to give last words to our three panelists. So, Cass, do you have any final perspectives? And otherwise, if people wanted to reach out to you, who are you looking to connect with? We've got a lot of great institutional people that are in the audience here, some great speakers coming up, as well as a lot of industry participants, potential issuers, all kinds of clients, partners, and investors. So what are you looking for, and what are your kind of final thoughts here?
I'd love to connect with anyone who's trying to really solve and create, a good use case for this technology. Honestly, I think the provenance question was raised earlier. Folks that are trying to figure out chain of custody. These are wonderful things that this technology does, and that they're trying to be players that are trying to be transfer agents, broker dealers, ATSs, but that don't look like traditional transfer agents, broker dealers, and ATSs, that are trying to be more efficient. And rather than, I think this has been a theme, but rather than leading with the technology, try and lead with the problem that you're trying to solve, right? We see, our subscribers would love to be able to look under the hood and see, oh, this is the same person that has owned the security, or here's who owned it, and here's the chain of custody. That way I know that I'm safe in facilitating the transfer of this. That's the problem, isn't it? However you solve that, if you're trying to figure out how to solve those problems that exist, there's friction points in our markets today that I do believe can be solved with some of these innovative products. But so those types of folks that are working on solving that, and you're going to figure out how to be registered as a transfer agent or an ATS or a broker dealer, but you might not look like the traditional one. Those are the people that we'd love to work with. Like I said, we have a very decentralized approach to this, meaning that come connect and facilitate, connection with your counterparty through our markets, but bring whatever model that you have. So we're always interested in talking to anyone who's doing anything innovative there.
Wonderful. Richard, final thoughts, people you want to work with? Give us the sauce.
Well, we always want to work with great companies or people who have great projects that are seeking capital. That's what we do. My final thought is that, first of all, you guys are all super, super smart and well-spoken. And I learned a lot. For us, it comes down to a couple of things that the people on this panel discussed. Quality, credibility, that's what is going to attract investors in the secondary market. And the technology, although complex, plays a huge role in facilitating trust and credibility. And that's the opportunity.
Wonderful. And finally, Mr. Jamie Finn, can you close us out?
I would invite kind of everybody to try it out. Our platforms are live and operational, which is a nice thing that everybody on this call can access. And we're always looking for great kind of, right now we're very focused on funds. and asset managers. We think that category lends itself very well to tokenization at this point. We've worked with obviously great companies on like yourselves, and Exodus tokenizing equity works out great. We did a huge Reg A with them. So the products are there, the platform's there, come and check it out and try it. And I think that's the key thing here is we're all learning together, and you got to use this stuff.
Wonderful. Well, thank you for everybody for tuning in. Thank you to my amazing panel. We are queuing up another panel as I speak. So we're going to take a quick break here on the video to get the next panel in. Anybody check out Blockchain Explained, our new best-selling book, if you want to learn more about the technology. And we'll talk to you with the next panel. And hopefully good. Perhaps we can all leave. Thank you to everybody in the panel. And
thanks, guys. Appreciate it. Cass, I know you well. Richard, I'd love to connect with you. I'll send you a note. Maybe we can.
Yeah, likewise. Great job, everyone.
That'd be fantastic. Bye.
Thanks.
thank you. So I'm not sure if I'm still online or not, but if I am, I can regale the crowd with a great breakdown of Blockchain Explained. So the funny story here is that Herwig, my business partners, Herwig and Peter and I, 19 months ago, started writing this book, which actually worked out to be pretty good timing for the industry. Because while, of course, over the last couple of months, there has been some issues with respect to the technology, or at least the financial price of the technology. We've been in a little bit of a bear market as of recently. So, it actually worked out pretty good to write a book, because that's fortunately when a little bit less of the innovation's happening, because there's not quite as much venture capital dollars that are being deployed, because the innovation isn't exactly accelerating at such a pace. It gave us a good tranche to be able to work on the book. So we talk about everything in there, specifically security tokens, as that's been our focus over the half a decade now of security token market and everything on board. But we really cover everything from blockchain fundamentals to the cryptocurrencies to the blockchain, and how all the business use cases of these things come together. And so it's been a really exciting journey. It took us 19 months to get it done. We cover a narrative of 150, 200 pages of what's actually going on, and then define every terminology of everything throughout the book, and have graphics and images, and it's been exciting. We've used it as an opportunity to teach at local universities here in Miami, between University of Miami and FIU and others. And it's also presented a great opportunity, I think, to help define a lot of the jargon. As we talked about on that most recent panel, it's not always clear what everyone's talking about. And even when you have seasoned professionals who are, raising millions of dollars for their own businesses or for other companies, when you've got significant developments happening in the innovation, sometimes we still may not always be on the same page. And so because of that, it's really important, I think, to all come to consensus on what we're talking about, defining and preventing jargon from being the thing that holds up a productive conversation, a deal, and all of those great things. So fortunately, due to a lot of the best players that we have in the industry, we're good to go. So I think that's just about it for us, and appreciate everybody watching.